Major equity markets are higher ahead of the two-day Fed meeting, and investors continue to digest fiscal cliff debates as we enter the last stretch of 2012. I'm Nicole Urken, and the morning call starts right now.
Good morning, I'm Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm Nicole Urken with theStreet, and together we bring you the morning call. Now, Scott, the markets are higher as we head into the two-day Fed meeting. That said, headlines continue to dominate. We have the fiscal cliff, we have North Korea, continued European issues. What are you thinking of going into the second half of the week right here?
I think the market's been absorbing them very well. You know, about 2-3 weeks ago, anytime we heard a news release about the fiscal cliff and how they're not getting close to some type of compromise, the market would just fall apart. Now, when you have Reed come out and say they're not close, all of a sudden you get a little bloop lower, but we're not falling apart. Right. There seems to be an underlying bid in this market. There seems to be a nice stair-step approach that's been very constructive since the November 16th lows. And like you said, there's even more headlines out there. You have North Korea testing a missile, and then you had, what happened with Italy? You had Mr. Monti saying enough is enough.
See you later. Right. And you know, the fiscal cliff rally that we've had, the big question is, well, are investors saying, well, if we go over the fiscal cliff, it actually doesn't really matter that much, or is there optimism that we're going to see a resolution? The jury's out on really what's driving that rally, but we're seeing it, and like you said, that maybe is a sign of a healthier market running into the last couple of weeks of the year.
Well, the interesting is everyone likes to put their finger on why the market's going up, instead of just looking at the action, looking at the stocks, and looking at the rotation, because there has been a lot of healthy action. You know, granted, you have to maneuver these ranges, and granted, you have to be in the right place and look at chart patterns to figure out what tier size you want to be in. But overall, since that November 16th low, the place to be has been in stocks. Equities, I don't care what Bill Gross or some of those guys say, they're far from dead. You just have to learn how to maneuver them and not really be focused on the crazy headlines of the fiscal cliff, the this, the that. You know what, there's always going to be nasty headlines out there. Just see how the market approaches those headlines. Right,
and speaking of maneuvering, you know, now that we are well off our lows, it is a little bit harder to come in here because there are still these headlines, even if we want to ignore them. So what levels are you looking to come into here now that we have had a little bit of a run?
If you look at the chart of the S&P, you'll see, you know, this is my roadmap, and this is what I look at. Okay, here is when, you know, remember that June 4th low, nice methodical uptrend all the way up to that 1474 high. Then it got really choppy up here, and then when this trend line broke, that was your time to take some risk off at 1440. You know, that's when we broke below the key moving averages, and from there, you had a 7-8% move down to the downside. Then we were looking for some type of reversal. There it was, November 16th. Then look at this power off of that. So that showed you appetite for stock. Then we held higher, and now, you know, fast forward to where we are. Yesterday we broke above this another obstacle, another trend line. We didn't have so much power, but I think it's fine. I'd say the longer we stay now above the 50-day and perhaps, you know, put in another floor to trade against, because look, you had a floor right here, a floor right here. You know, I don't think we're going to run away, but if we can now hold above 14, 15-ish, you know, and do some sideways action, I still think we can continue higher. It's just how, and it's just the speed that takes place.
And you know, one thing you and I have come back to consistently on this program is what's a leading indicator. And one thing we've continued to come back to is the Qs and tech. And especially from a trading perspective, you've taught me that tech is very important from a momentum perspective. And so the Qs here we've seen have been strong, and that's something we want to dive into. You know, from an investment standpoint, these names, some of the mega cap names, have been a little down and out because there have been concerns about corporate spending with fiscal cliff overhang. How much are companies willing to spend their IT budgets and whatnot? But from a technical perspective, what do you think for the Qs, and what does that mean for the overall market?
At least now it's not a headwind. You know, back in October, the Qs in technology was lagging. They were showing signs of a breakdown. So actually it was helpful because it gave traders like myself some clues that we could be headed for a downturn. So with that said, you look at the chart of the Qs and you will see, I'll show you something right here. Remember this pattern here, this head and shoulders top? Just want to show you, look at this date. Okay, this was October 9th. That's when the Qs broke this upper area and then retested and continued. If you go back to the chart of just say the SPX, okay, look at this is where it was on October 9th. And right here, still didn't break long-term support. So right there, that was your clues to be careful. So now at this particular point, the Qs are not lagging so bad, and they're actually in line. And I see a little pattern here that's interesting for higher prices. This is called an inverted head and shoulders pattern, where you have the left shoulder, the head, the right shoulder. You have a defined neckline right here. So at this point, the longer it stays above now, just say 65-ish, I think the higher the probability it gets above the 66.5, and we could see a move back to retest, maybe even by year's end, this 68 level, which would be very healthy for components of this indice.
Right, and diving into some of those components, the mega caps obviously are big drivers. Again, corporate spending being a big concern. And we were talking earlier, Cisco and Oracle have had some nice momentum. So, looking at the charts, what are you seeing here? Oracle, we have earnings next week. Cisco, we just had an analyst day. So what are you thinking?
Well, if we go into Oracle first,
yeah.
Oracle, for the past actually like 3-4 years, it's been a chosen one by institutions.
Right.
It's been acting better, like with IBM, and some of the other mega caps have just been trades.
Right.
At this particular point, you look at Oracle, and you'll see that it had a nice move off the lows. It's above all the moving averages, and look how close it is to the September highs. And then if you go even further back, it's been a lot to like, even all the way back from down here. So investors that have been with Oracle have been rewarded. So at this particular point, though, the closer you go to these highs, the more you have to be a little bit weary that they better perform and they better have good numbers, because there's a lot priced in here.
Right. So look out for those earnings next week. That being said, it's at 12 times PE, 20% EPS growth. Hardware expectations really low. License expectations for the software side pretty reasonable. So it might be an interesting trade into the quarter next week. But like you said, it's had a nice recent run. Yeah,
and it can continue. They just have to, not miss.
Right, exactly.
Where it's something like you said, Cisco also been strong.
Yeah.
They had their analyst day. Last quarter, actually, Cisco, after missing a few, surprised the street a bit because they thought they had exposure so much to Europe, to the public sector, this and that. And meanwhile, Cisco had a good report. And if you look here, one of my tactics that I like is when you have a gap up like this, and then it holds the gap up. Look how Cisco held the gap up. So this is your entry. Then it started to go. This was your add. And now it's had a really nice move, and it's been following the 8-day the entire time, which is unusual for Cisco. But as you get higher, you have to really perform. And at this particular point, it's had a big run. I would say trim some into this area, because they're also pricing in a nice report. It's not all the way down here in the lower level like we'll see with other mega caps. But at this point, if you've been riding it, it gave you lots of technical reasons too. If you're not in it, maybe it comes back to the 8-day, and that's somewhere I'd rather see you buy it a little bit closer to 19 versus chase it up here, closer to that 20 area.
Yeah, I agree on that completely. Trimming some makes sense. Obviously, Cisco's a play on some normalization in CapEx spending. Well, we've had a holdback, but it has had that run. It wants to be the #1 IT vendor, so it might be interesting to come back into after we get a little bit more of a dip. But thinking about other names that have been down and out, we were talking before, Microsoft is one. I mean, this one has been a dog. And again, though, at this valuation, it could be an interesting trade, again, just on this macro theme of improved spending cycle. Microsoft is trying with Windows 8. They're trying with the tablet. But, is this a value trap, at least from a chartist view? They
also tried with the Zune, and they also tried with, I think there was some
kind
of
effort.
I was listening to 1010 Wins on the way in, and they were also doing something with one of their tablets where they were expected to sell a certain amount, and they sold a lot less. And it shows you, because timing is key, especially with these. Like earlier in the year, Microsoft was a great trade before it started to falter, and you have to look for those signs. And if you look, at the year, if you look at Microsoft, you go back to here, okay. Look how nice and technical this breakout was. Boom. I think I talked about this with Margaret Brennan on Bloomberg. That was your technical move. Boom. It went to as high as 32, and then it started to show technical damage, where you had a high, lower high, lower high. Then it started to not act well, went below the moving averages. So if you sold into some of this strength, or on the double top, so to speak, now, here it's interesting, because you see some type of bottom formation. At least you have a point of reference here. This is what? 26.26. It responded well the last 2 days. You have a descending channel to trade it against. So I think if you're long Microsoft, you could stay with it. If it holds above, just say the higher end of this range, so it'd be nice to see it hold above yesterday's low, even in the face of some of that bad chatter this morning, like 27. You could get another trade through this area to test the moving average. So at this point, I think that it's in the game for some follow through, and then we'll have to see how it handles these moving averages. But this is a laggard play, and laggard plays sometimes are good for trade, sometimes they're good for more. It's not showing relative strength, but the market's been a little weird where people are selling winners.
Yep.
because they don't want to pay higher taxes next year. And some of these lower level trades, where they're the highly shorted beta names, or some of these lower level ones that are coming off the lows. So just watch the price action.
Yeah, and lastly, in the mega caps, Intel's another one down about 15% year to date. An interesting entry point: CEO transition. It's a company that's gotten too deep on Moore's law, a little behind on the tablet smartphone game. But again, there's risk of, well, it's not going anywhere. But especially with a new CEO coming in, some new initiatives, it could be an interesting trade. Again, corporate spending, that cycle, again, that being the theme for all of these names.
Right, and they have a lot of cash and the PE's low. And
yes.
I started talking about this last week. I'm actually in this one. And of all the mega caps, I chose Intel because of the setup. Not because I love the company, not because I think the iPad's going to start using their chips over ARM or CRUS or a special cash dividend. But I said, you know what? This was a nice looking chart earlier in the year, like Microsoft. The whole PC sector has been battered and bruised, but some of these stocks are actually even experiencing a little bit of like a January effect. So you go to Intel and you take a look at the chart here, you will see there were times to sell it and times to buy it. Okay, if you look right here, when it was stronger early in the year, here is your breakout failure. You never want to see a stock try and break out and boom, get rejected. Then you had a high, another lower high, and then this is when it broke support. So this was another area to get out if you didn't see these signs. So now, fast forward to where we are, it's sort of rounding down here. So for me, I was looking at this 2020 area, right around here. I know it didn't go well right away, but it held above it. Yesterday you saw a nice percentage move, so it was good to be in Intel. You could make a few percent. Next level here is this moving average, and then at some point maybe into the first quarter 2013, you could see 2360. That's where you have some big resistance, and for a stock that has a decent dividend, a lot of cash on the books, a low PE, entering down here, it could make some sense for you if you have some time.
Right. So think about Oracle into the earnings next week. Think about Microsoft and Intel as potential laggard trades. Now moving into some of the momentum names, the heartbeats of the market, as you call them, within the Qs: Apple, Google, Amazon. Now Google and Amazon are interesting dichotomy because the market's given the benefit of the doubt to Amazon as it continues to spend. Google, the market says, hey, what's happening here? But interestingly, Google is well off its highs. It's had some interesting action of late. What do you think going into the end?
Well, so if we go into Amazon first,
okay.
Amazon, like you said, traders scratch their head all the time, like, how could this stock continue when their earnings aren't great and whatever. But I think a lot of people say that as soon as they ramp up, their margins will get a little better, and then their earnings are just going to pop up.
Yep.
And they can just keep giving them passes on the street. And if you look at the chart, it's been tradable. This was that descending channel all the way into the 200-day. This is when it popped back up. You just had a quick move back to the prior high, so you see some resistance there. Some guys caught a nice little trade the other day when it broke below this 250, but then it didn't fall apart. So now, if it goes sideways for a while, you can put another little flag type pattern here. There is a chance that it goes above 255 and continues. So my traders will probably be watching the next few days, and if it starts to, stay around this area, I would not be short and can continue. Like you said with Google, Google feels as if they're like, why don't we get the love of Amazon, right?
Right.
Well, it could be because they need to split the damn stock, and it's like
which is supposed to be pending. So that that should be coming, shareholder approval pending. But I think, it's interesting, Amazon and Google on Mad Money, we talked about both of them as the anointed ones, the ones that could do no wrong. Google, we've seen a little bit of a sell-off, but ultimately both of them are dominant in their markets. You have Amazon dominating e-commerce. You have Google dominating search. Again, as opposed to the mega caps, these are more momentum, metrics driven.
Right.
But it is, again, spending, corporate spending, individual spending, advertising. These are dominant names that have been really hard to bet against. And I think Google, Amazon, Google's an interesting entry point here because it's not at its highs.
Right, and they reported midday, which threw some traders off, and psychologically that tarnished the image of Google with traders. But last week you saw with Google a nice entry. Google I put as my 2012 stock pick of the year. I said it can go back to the highs of 747 up till 8 and change, and there are still times and place to get involved. That's why you have to learn the technicals besides all those fundamentals you just talked about. So you go to the chart of Google and you will see this is when it started to act much better. If you remember right around here, this was 2 quarters ago. 2 quarters ago, it finally gapped up right around here, right around the 600, finally broke this downtrend, and then you had an unbelievable ride all the way up to the highs here. And if you look actually technically there, you actually see a topping tail. Okay, right there. There's your little topping tail. Not blaring, but tried to make a high, had no momentum, and then this was your first little wake-up call that this ascending channel, broke to the downside, so showing you that it could be over, and then pow. All right, so it took a lot of the meat off the bone in that move because it engulfed this entire 2 months. So from there, it's been repairing. Stocks take a long time to repair after a big move like that. So here's that reversal. That was November 16th, just like the market. And then I think about a week ago, I was talking about it breaking this trend for a trade, 661, 675 as a trade. You had to move back to the 50-day. It paused, and now it's holding above 680. The longer it holds above the 680, there is a chance that finally it takes out the 50-day, and you could see another move to 720. So at this particular point, it's trying to repair. But everyone says always to me, they're like, okay, you talk about stock splits, it's still the same PE, it's the same fundamentals. But lately, it's a lot of psychology.
Yep.
Individual investors don't want to buy a $700 stock.
Right.
Hedge funds are even feeling a little uncomfortable about it. So why not split it like 10 for 1? So this way it's not like a blimp hanging in the sky like an Apple where the high frequency traders can go nuts with it. Traders use it more technically versus fundamentally. So split it, and I think investors would be rewarded.
Right. And speaking of technically Apple, it seems to be the most technically driven name, and so we continue to defer to you. Last week, we saw pressure in the stock. There were talks about Nokia in China. There were talks about margin requirements. There were talks about AT&T maybe not having the iPhone shipment numbers that people were looking for. Just quickly to finish up the cues with one of the most important names in the market, what do you think of Apple going into the end of the year?
Well, it all depends on your time frame.
Yeah.
And I've been trying to connect the time frames where you have a macro pattern that could be really bearish, okay, because psychologically from 700 down to 505, it knocks some investors' confidence down.
Right.
And then, we had that low on November 16th, right around 505. That play was, buy it around 522. And it gave you a quick move to 594, but that move was met with 3 days of selling real quick. You look at the chart here of Apple and you'll see, here was that head and shoulders top, the left shoulder, the head, the right shoulder, broke that neckline around 660, and then it broke this trend line, and then it just continued to the low. Finally, you had a little bit of a reversal. From there, it was a methodical trade back to the moving averages, and then it failed real quickly. If we take a micro look right here real quickly, just because a lot of people are trading it now day to day because they're not sure what to do and trust here, then it had a reversal on last Thursday to then, then just to get engulfed on Friday, and now you have a 2-day move here. So I know I'm along a little bit. It was actually somewhat constructive to see it hold the gap yesterday. So I would say if it could hold above 537 to 540 for a few days here, there is a chance for it to overcome another obstacle, get above this 555, and then you'll see 571. So I'm taking a very incremental approach with it. I'm not saying it's Apple. I'm just going to hold it. I'm going to watch the price action, because if you look at the macro chart, so if we go back to this one more time, and you look here, there's definitely a decent case for some people who are saying that you have your left shoulder, the head, and then this could be a right shoulder forming, right there, where if it doesn't get above, if it stays below 555 and it can't take back this area or break this trend now that you have in place, a really big downtrend, this 505, 518 becomes vulnerable, and then there's not much going on here down to 440. So at this particular point, I think you can't just close your eyes and say I'm in Apple, I'll be fine. You have to watch it closely, know your risk, and know your time horizon.
Right. And speaking of time horizon, one pressure on Apple, also people have been in for a long time, there's the capital gains tax consideration. So some people are just selling here after a big run over the longer term. Speaking of government, we're going to jump into some names in the crosshairs of the government after the break as we go in the trenches, so stick around.
Hi, I'm Sean Hendelman of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
Welcome back. We're going to dive in quickly to some names in the government crosshairs. AIG was the talk of the town yesterday. Government getting rid of the stake. Now we can trade back to fundamentals, a much more simplified business. What do you think here, Scott?
I think the stock reacted well. Everyone wanted it to happen. They didn't sell the news, so I think it's positive for AIG. I don't personally love the stock or love the company, but at this particular point, you look at the chart real quickly, you'll see it had a nice breakout. They didn't sell it on that news, and now without them selling, it could continue higher. I would say if you're in AIG and you've weathered this storm, just make sure that it stays above and keeps riding the 8 and 21 day, because if that breaks, then you might see some downside. But ultimately, it acted well on that news and could see more upside.
Yeah, Ben Moshe said yesterday they're still in the beginnings of restructuring. They've shifted from a complex financial over-leveraged company to their core insurance business, which is on a cyclical upswing. There's a lot more to go here. They are owned for Action Alerts Plus, an interesting name. Other names in the crosshairs, a name that has been acting really well, McGraw-Hill, just spun off its education business, MHP. It's been very strong of late, nice into the end of the year. What are you thinking?
If I'm looking at the chart, I'm thinking, why haven't I traded this one? It's at highs. Just goes to show you that you could be in names that that are kind of off the beaten path. And for this one, you look at the chart real quickly here. It's had a really nice move. It held higher during that correction, and pow, right at the highs. You always trim into highs, but this is giving you no reason to sell it yet.
Right, and it feels like a long time ago, but MHP again is parent company of S&P, and that has been in the crosshairs because of the credit agencies. They missed the financial crisis, et cetera, et cetera. Moody's is the other one, MCO. As regulatory overhang issues continue to take a back seat, continue to be pushed away, continue to be managed, again, these names can trade on fundamentals. For MCO, what do you think?
There's actually a trade here. I'm looking at it right now. It's near the highs. It's flagging. So if we go right to the chart just to show you, here you are. This has also been following the 8 and the 21 day. It's flagging right here. So at this particular point, if this gets above 49.95, it could make new highs in the year.
Got it. And lastly, GM, General Motors. The government still has a significant stake, European overhang, but a lot of moves into the emerging markets, a little bit of continued cyclical upswing in autos in the North American market. From a fundamental perspective, I'm not a buyer right here, but interesting to keep on your radar if we continue to see any nice entry points. From a chartist perspective, what do you think?
It's very sloppy. It's choppy. I trade this maybe 4 times a year with Ford. Just because they're set up sometime, and as I look at the chart of GM right here, you look at it and look at these moves. Down, up, down, up. This is a choppy mess. But every time it touches the 200-day, it seems to hold. So for the first time, let's see if it doesn't go back to the 200-day and holds higher. So if GM could hold higher here and hold, just say, above 24.50, maybe there's a chance coming into 2013 if the recovery gets a bit stronger, it trades above there and gets back up to that 28 area. So it's worth holding. It's just nothing to be enamored with.
Right. Well, we're going to wrap up there. Obviously, government considerations, when they go away, you can trade again on fundamentals, and that seems to be the theme of the market toward the end of the year. When can the headlines move away? When can we start trading from a bottoms-up approach? Right now, it doesn't seem that's the case quite yet. But happy trading, happy Wednesday. Good luck. Lots of Fed news to digest coming later today, and thanks for being with us.